All right, section 5 of day 6 here, this last section of the day. Let's talk a little bit about consolidation in the U.S. banking industry and how the U.S. is moving towards having a smaller number of bigger banks and what are the potential impacts of that. So here's looking at the share of bank financing in total borrowing. So basically looking how much of total credit is advanced by banks. And we can see here that this number has fallen since the 1980s, right? Commercial banks have declined in importance, in part because they face very strong competition from US financial markets, particularly US bond markets, right? The US bond market continues to be the biggest and most efficient bond market in the world. The advent of things we talked about here a moment ago, like commercial paper and the money market mutual funds, has really led to many firms being able to raise money without the help of banks. And so banking is facing some pressure here, right? So banks here face this pressure. They also face this pressure to get higher returns. And of course, to get higher returns, you have to accept more risk. And so, banks have increasingly tried to do what we call loophole mining, right? Find ways to cut costs and get more competitive. One way is to try to avoid paying required reserves, right? Try to raise money in ways that they don't have to pay required reserves. So try to raise money outside of checking accounts. Try to raise money through money market mutual funds or through sweep accounts. So we won't even get into what sweep accounts are, but basically it's a way of kind of at the end of the day, taking money that's in checking accounts and temporarily moving it into other bank accounts so that you don't have to pay required reserves. This pressure, though, has also led to a decline in the number of U.S. banks as there's been all this consolidation, right? Big banks are eating up small banks and creating a smaller number of bigger banks. This has in part been due to deregulation. The Regal-Neal Interstate Banking and Branching Efficiency Act of 1994 allowed banks to basically operate across state lines. They've been doing that for a while, but the process got a lot more advanced after 1994 when it became much easier to operate across state lines. Economies of scale and information technology have encouraged big banks because big banks now have more access to information, and information is a huge input into banking. And then, of course, the other thing that led to a lot of consolidation in U.S. banking was the 2008 financial crisis, right? And we're going to talk about that more later. But many of the biggest financial institutions in the U.S. got eaten up during the financial crisis because many of the biggest ones were in danger of going out of business. And basically, the only way that they didn't go out of business was to be merged with other stronger partners. And so here we look at the number of commercial banks in the United States, and you can see this precipitous decline since 1980. Now, the US still has far and away many, many more banks than other countries do, right? So the US is still unique, right? Even though we have maybe less than half of the number of banks we had in 1980, we still have many, many more banks than we did before. But what we increasingly see is that while there still are a lot of banks in the US, most of these banks hold relatively small amount of money, right? So the banks that are less than 100 million only hold about 0.5% of all assets. Banks between 100 million and 1 billion, which is most banks in the US are of that size, between 100 million and 1 billion, altogether only hold about 7% of all assets. But look up here at more than 250 billion. There's only 9 US banks that are bigger than that, and they hold half of all assets. So there is a lot of consolidation, right? The 10 biggest banks here are the 100 biggest banks, right? If you take the 100 biggest banks, they owe more than 80% of all assets in the financial system. And so while we still have a large number of banks, right, there's still a lot of small banks out there. increasingly, it's only these top 100, and of the top 100, particularly the top 10, that matter for most lending. Who are these top 10? Here's just a brief look at this. JP Morgan, of course, is the biggest one. JP Morgan basically jumped to the top of this list during the 2008 financial crisis because JP Morgan was, of these banks, the one that was kind of in the best financial situation before the crisis began and kind of weathered it the best. We have Bank of America, Citigroup, Wells Fargo, US Bank Corp, Bank of New York Mellon, PNC, Capital One, HSBC, and TD Bank, right? So some of these you've probably heard of before. So the US banking system is gradually looking more and more like other countries. Is bank consolidation a good thing, right? If you remember back in the Great Depression was in many ways blamed on bank consolidation, right? That banks were too big and they were too closely involved in not just commercial lending, but also in investment banking. They were too heavily involved in the stock market, in the bond market. The Glass-Steagall Act of 1933 separated commercial and investment banking. But the Glass-Steagall Act was revoked in 1999 under the Graham-Leach-Bliley Act. And today we have universal banking, right? So banks can basically be involved in commercial banking, but they can also be involved in investment banking, and they can also be involved in insurance, right? Providing life insurance and property insurance, right? So do many different sorts of financial activities. So if you think about Citigroup, right, which is a big financial conglomerate, it is the second biggest bank, Citibank, coupled with Travelers Insurance, which is the third largest insurance company, combined with Salomon Smith Barney, which was the third largest investment bank, right? This has created a huge financial conglomerate. Now, why should we allow these kind of huge financial conglomerates to exist? Well, there's really three arguments, right? Supporters of this say, listen, these big banks are, efficient and they're competitive. Big banks can be diversified in ways that small banks never can. So these big banks will have lots of information, be really efficient, be very diversified because they're going to operate globally. That will make them safer. And then the third argument is basically, listen, banks find ways to do what they want anyway, right? Whenever you write a law or try to regulate a bank, it will find a way to loophole. They'll find a way to exploit a loophole. And so why don't we just let banks do it, right? This is kind of the resignation argument, that banks have always found ways to avoid regulation in the past, so why do we even bother? These are really kind of the three arguments for universal banking. But the critics of universal banking point to these potential dangers. First off, there's the problem of too big to fail. And we definitely saw this during the 2008 financial crisis. Many of these big banks were simply too big to fail, right? Not only would their failure have led to many, many losses for US citizens, but because these big banks had feelers in almost every other financial institution, if one of these big banks would have failed, it would have brought down many, many financial institutions with it. And so the problem with having these too big to fail banks is that they know that. And if they know that they're too big to fail, they're going to feel like they can get away with doing whatever they want. And that's moral hazard, right? So another argument against universal banking is that now investment banks have access to insured deposits, right? A commercial bank can use FDIC insurance to attract deposits, and then what can they do with that money? Anything they want, all sorts of risky activity, right? They're basically able to use taxpayer money to reduce some of the risk of their risky behavior. There's worries about universal banks simply becoming too complex, right? We talked about these structured investment vehicles and shadow banking, right? These universal banks are so big and so complex that really nobody quite understands what's going on in them, right? I don't even think that the CEO or the boards often understand what's going on in many of these extremely complex universal banks. And then, there's the worry that the bigger these banks are, the more impersonal they get. And the more personal they get, then the less that kind of local or community banking is allowed to exist. People get less information. People are more likely to be credit rationed because there's not that kind of unique and local information that's being collected by these big impersonal banks. So what side of the argument you fall on really probably is connected to how you view big banks in the first place, right? Do you view big banks as necessary for having kind of economies of scale and facilitating the kind of economic growth that we need at a national level? Or are you worried about the dangers? Are you skeptical about the value of big financial institutions and kind of worried that they're more looking out for their own interests than they are looking out for that of individuals? Honestly, there's not an easy answer to this, right? I think there's definitely good arguments to be made for universal banking, but there's also some real dangers associated with it. And we'll come back and talk about this more when we talk about the 2008 financial crisis, right? We'll kind of come back to the ways that universal banking played a role in the 2008 financial crisis. To finish up here, let's talk briefly about international banking by U.S. banks. There's over 100 U.S. banks that have branches overseas, and they have about $2.5 trillion in assets. A lot of these banks operate in London and Asia and the Caribbean. And you might say, why in the world the Caribbean? Well, this is about tax avoidance, right? And so a lot of these U.S. international banks are in many cases operating overseas, in part because of international trade, but also in very large part because of tax avoidance, right? That rich, wealthy U.S. individuals are trying to hide their wealth from U.S. The IRS, right? And so, and many U.S. banks are helping them do this, right? Essentially helping them do this. And then part of this overseas banking is also driven by tax or regulation avoidance, right? Trying to avoid regulations like required reserves, right? So Eurodollar accounts were essentially started in many ways as a way of avoiding regulation and avoiding required reserves, right? A way to borrow money in dollars that didn't require banks to pay required reserves. And so while there are good reasons to have U.S. banks engaged in international banking, a lot of what international U.S. banks do is also kind of ethnically questionable, right? That'd be a polite way of saying it. We also have foreign banks operating in the U.S., right? Foreign banks own about 20% of all U.S. banking assets and do about 22% of the commercial lending. I think we've said this before, but for a practical matter, there is no difference between whether the bank is a foreign bank or a U.S. bank in terms of how they conduct their business. They have to abide by the same rules, same regulations, same laws. There's also global banking laws that apply to any bank that operates internationally, specifically the Basel Agreement, which we talked about a little bit earlier today, which is the capital adequacy laws, right? The capital requirements that banks have to meet. The Basel Agreement only applies to the largest international banks. So to get a feel for who the largest banks in the world are, here's table 3. And you'll notice a couple of things here. First off, the 4 largest banks in the world are all Chinese. And we will definitely come back in this class and talk about the big 4 Chinese banks. And we'll talk about the Chinese banking system, because understanding the Chinese banking system is crucial to kind of understanding global finance nowadays. So we'll kind of come back and talk about these big 4, but you can see they're a huge portion of global banking. You notice that there's only 2 U.S. banks here, but if we had looked at this list in the mid-2000s, there would have been 0 U.S. banks, right? So this is what we're talking about, that there are bigger banks. The U.S. is looking more and more like the rest of the world, and we now have a couple of banks up here on the biggest bank group, right? So anyway, this kind of gives you a feel for who some of these biggest international banks are. Okay, well, that really kind of finishes our discussion of banking here for a Monday. So remember that tomorrow, right, if you're following the schedule, tomorrow is our first exam. And I will definitely communicate with you about the details of the first exam. That will really be the only thing that's required of you to do tomorrow. On Wednesday, we will begin to talk about bank crises and about why banks fail. Also, you have homework number 2 that's due on Wednesday, so make sure that you pay attention to that. All right, hope all is well. Hope you are safe. Hope that things are going okay. And of course, be in contact with me if you have any questions or any problems. All right, all the best.